And then the next one that I want to go through is the macroeconomic risk scorecard. So the macroeconomic risk scorecard, what I love about it personally is the most important component of it is it's allowing you to say out of these 7 recession risk models, so it's 6 plus 1, that's a composite, that's model 7. What is the probability of us experiencing a recession, which is defined as economic contraction? Um, and, and defining recession is actually quite complicated because in the US, for example, they have a National Bureau of Economic Research, which is a committee that is the de facto committee that's responsible for identifying a particular period of time as being recessionary or non-recessionary. So, and usually what they will look at are a lot of the variables that you see here that we'll go through, specific metrics. But ultimately, you see on this graph, it's just so helpful to be able to see all the models overlaid on top of each other. So if I want to go and I want to say, okay, and then in red, if you can see it in slight red, that is past recession. So the most recent recession that we had was during the US COVID disaster that we had back in March and April of 2020. I'm sure everyone recalls that. It was a nightmarish scenario for everyone. But you could see exactly that the models were starting to trend upwards as the recessionary risk was increasing prior to the recession happening. And that's exactly the intent and why this has been modeled and engineered in this way is for us to be able to accurately predict when the next potential recession could be. So if I only look at if I want to filter this down, I want to just look at like the last few months. And then you see there's also a sort of a 6-month projection out. So by the end of this month plus 1 month, we'll be able to get the Q2 numbers in. So that's important. So when we get the Q2 numbers in, usually it takes about 30 to even 47, 48 days to be able to get the last quarter numbers in. That'll be very helpful to be able to see whether or not our forecast is accurate or inaccurate or needs to be recalibrated and fine-tuned to be able to be improved in terms of an accuracy standpoint. But again, back to the recessionary risks model. So there's 7 different models, and one is based upon our own proprietary formula that we use, where we're using like gross domestic product, gross domestic income, employment level, income level, consumption, industrial production score, that's like 0 to 100, and then delinquency rates. So that's delinquency rates to me is probably one of the most important early indications of what a potential recession would be. And then a second model is a GDP 2-quarter rule. That's usually what people use. And then there's also a yield curve. There's a Sahm rule where it was a very famous economist named Claudia who created the Sahm rule. It actually has 100% accuracy, but only when it hits 100 or 0. Like that's the thing. It creates a bit of a noise with false positive when it goes up to 70 or 80, like it did recently. And then there's a credit stress indicator based model, and then there's leading indicators that are usually derived from like volatility based indices and so forth. And then M7 is just a combination of all 6, right? But the main recession metrics are the same ones that I mentioned, which are here. And then you could also see the unemployment rate, the yield curve, inversion of yield curve, volatility indexes, jobless claims, etc. But these to me are among the most important in terms of being able to predict the next potential recession is looking at delinquencies and debt, because usually what you'll see is consumer loans and commercial loans and real estate loans beginning to default and or delays in people being able to successfully repay their debt. So if you have higher debt obligation, you have higher rate of default, you have higher probability of insolvency, and then that drives you to a bankruptcy or foreclosure, depending on what asset class we're looking at. And that in itself complicates everything in your life. And if you are then just extrapolating from there forward, you could see how that has a bearing impact on the entire country's economy and the entire world's economy. So, and this is just for the United States. So you would look at this for all of the other markets as well, and you'd be able to to take a closer look as well, of course. But you see, it's right here. So you can do the same for Canada, Japan, Germany, France, Indonesia, Saudi Arabia, South Korea, etc. Now, these are all the different markets that you would want to have where you can take a look at it. You could do it by country and by currency and then just refresh and it'll be up and running. So beauty of this too is it also allows you to be able to see our own proprietary geopolitical risk index. So this is scanning the entire world of geopolitical and macroeconomic risks and events that could potentially be helping or shocking the economy. And that is very, very important. So this is continuously scanning any potential threats that are out in circulation, like economic uncertainty, crude oil prices, like the Hormuz trade closure is having a very significant effect on the quality and the volatility and the integrity of the market itself. So geocom is very important, looking at yield curves, market volatility, consumer confidence. Credit risk appetite is hugely valuable for us to track as well. And right now, close to all-time high in multiple markets, including equities. So it is very much in a greedy market regime. And then you can look at also from the crossover of macro with liquidity and seeing if there's some opportunities there. There's so much. You can also look at the monetary policies and central bank policy rate divergences. So to me, this is very interesting because you want to see whether or not there's going to be any type of interest rate cuts or there's going to be a road to expansion or contraction. And usually if you reduce interest rates, then you make money more affordable, you make capital more accessible. And by doing that, you're expanding the amount of possibilities that companies and institutions can pursue, right? So they can pursue different acquisition opportunities, different private equity starts heating up, and then everything else starts booming. So usually you want reduction of interest rate to try to re-stimulate the economy and drive up demand, but you have to do it in a very careful and methodical way. Otherwise, you're going to drive up the prices of particular products, and then you're going to have inflationary pressure. So it's a very fine trade-off that you have to balance, and that's why it's not as simple as, oh, well, reduction of rates drives up demand and drives up affordability. And it's not that simple. It does make some assets like real estate and commercial property more affordable, but then it's also going to make the prices proportionally potentially go up. So these are the types of considerations. Now, the beauty of the macroeconomic risk scorecard and the global liquidity scorecard that we just went through is that it gives you that entire perspective into really one unified view depending on what you want to look at. And then on the back of it, you can set up very sophisticated alerts and you say, I only want to be alerted when the net liquidity is above, let's say, 7 trillion. And then you just write as many zeros as needed. And then you say, I only want to be alerted every hour with a 24-hour cool down. So it's like one time within a 24-hour time block. And then you can have it where any time that net liquidity is above a certain amount, and this is just an example of one condition, you can execute a particular trade on the back of it. And you say, I only want to have those trades executed on my Charles Schwab or my Alpaca Markets or my E-Trade or my Hyperliquid account, etc. You can have it all unified under one alert. So there's so much you can do with live trading and also with paper trading. So that's the whole point. It's not just theoretical, it's application-based trade execution. And it's being able to do that in a more informed way is my goal. So those are the two core global liquidity macroeconomic scorecards.